So Pratik, what have been the guiding principles behind making this amended this new set of scheme, new set of regulations?
Right. So as I mentioned, this committee was guided in its policy thinking by the recommendations of the Financial Sector Legislative Reforms Commission. The committee had looked first at the theoretical framework for deciding on policy. So the first question that you need to ask yourself is, why do you regulate a particular market? What is it that you are trying to achieve? What is it that the regulations are trying to achieve? So according to the FSLRC framework, which is the framework that this committee also follows, regulations are meant to address market failures. So state intervenes into a market only and only if there is a market failure, and the sole purpose of the regulation is to address market failures. Now, in case of finance, market failures can be of four types. Consumer protection. There may be cases where consumers are being defrauded, like insurance companies selling insurance products without doing a proper suitability assessment and other consumer protection safeguards. There may be consumer protection issues. Second, there can be microprudential issues. For example, microprudential issues. So why does the RBI require banks to have a minimum capital? Because that is microprudential regulation. You want to regulate an entity so that it doesn't go bust, because a lot of people have their accounts with the bank, right? I mean, so you have to make sure that the bank is liquid and the bank is solvent. So this is microprudential regulation. This is a justification for regulation again. Third is systemic risk, right? So for example, if say a lot of Indian companies have borrowed in American dollars, right? They all face the foreign exchange risk of American dollars. So against the rupee, if the dollar's value goes up, then all of them suddenly will be affected by because their cash outflow will now, their liability will go up, right? So this can have systemic risk concerns for the entire sector which has taken American dollar loans. So there is a possibility of systemic risk arising out of here, and there is absolute justification to intervene to regulate this kind of risk. And the third is resolution. When because of a systemically important financial institution, a SIFI, it's possible that other participants in the market will get affected. Like if today SBI is to default, it will be a catastrophe. So you need a framework, regulations where the state intervenes and either kills the firm or else revives the firm, right? So beyond the point, a firm has to be killed. Its bad assets and good assets need to be separated, and you do whatever with the bad asset, you take the good assets out of it so that you prevent a contagion effect in the economy. So these are the four broad areas in which financial regulations should be operating, and not beyond this, right? So if you apply this framework into the DR market, let's see which of these principles should apply. Consumer protection, should it apply? Who are consumers here? DRs are foreign securities. They are not being sold to Indian consumers. So why would the Indian law want to protect American consumers? American laws are there to protect American consumers. So by adding another level of consumer protection, trying to protect American consumers, what we are doing in effect is we are raising the cost of capital for Indian companies which are seeking to raise capital abroad. So it doesn't make any sense. So we must understand which consumer protection aspects are trying to protect Indian investors and which aspects are trying to protect American investors. Now we must understand the SEBI's mandate, the securities regulators mandate, as the SEBI Act Section 1 clearly says, is it applies to the whole of India. So even if it wants to, it would be illegal for SEBI to try and protect American investors. And economically also it doesn't make sense, because the American regulator is anyways protecting the American investors. So why do you want to unnecessarily raise the cost of capital? If you look at microprudential, again, I mean, securities really do not affect microprudential aspects of Indian companies. Same with systemic risk. There are no systemic risk implications. And again, resolution, there is no resolution angle to this story. So it's only about consumer protection. So any intervention in the DR market should only look at whether it addresses any consumer protection issue, and that too only of Indian investors, right? So from this perspective, if you look at it, the DR market becomes much more clear, what to regulate and what not to regulate. And you will see that a lot of things that were there, that were being sought to be regulated under the 93 scheme, were regulating a lot of things that just does not comply with this theoretical framework. And I think the committee took a view from that perspective, that whenever there's anything mentioned in the scheme, whenever there's any regulation, it must comply with this broad understanding and purpose of regulations.
Can you explain the concept of home bias and regulatory constraints?
Yeah, so home bias is something very interesting, because the entire reason why you issue DRs is home bias. So an American investor would always want by default to invest in his home jurisdiction, because he's comfortable with his home jurisdiction. He's comfortable with US laws. He doesn't know what Indian laws are. He doesn't want to pay Indian lawyers. Why would he? Everyone is comfortable in his home jurisdiction. But at the same time, as I explained, he has an incentive to go abroad and invest in jurisdictions abroad, because he wants to reduce his volatility to risk, right? So Indian issuers, what they should do to overcome the home bias and take advantage of the American investors' interest in investing in India, is to issue DRs. Because you cannot expect every American, like for example, take pension funds and insurance companies. A lot of this American and Canadian insurance funds and pension funds cannot invest directly in an Indian security, because in the charter of those institutions, they are prohibited from investing in any foreign security. So they have to Indian in American securities, but they understand that if they could invest in a security in India, they could reduce the portfolio, their volatility risk of their portfolio. So you can make it more attractive in US to sell ADRs against Indian shares, because it's perfectly the incentives are perfectly aligned with their interests. So this is home bias. Home bias is basically the bias that any foreign investor has against coming to India and investing. So you alleviate the bias, or you try to get rid of the bias by issuing DRs abroad instead of expecting them to come directly into your jurisdiction.
Can we speak about the next barrier to accessing global capital, which is regulatory constraints?
Yeah, so there are a lot of capital controls, regulations in India, and there's this entire debate about whether capital controls should be liberalized or not. So capital controls are basically, they started off from post the World War, and it basically prohibits artificially through law the free movement of capital across jurisdictions. Now, if you have capital controls, there are regulatory constraints to investing in one jurisdiction, right? So there are n number of regulations under the RBI FEMA regulations, right? So for any foreign investor, it is, I would say, a subset of the home bias, because that generates home bias. That if you are creating a barrier against entry of foreign investors in India, you incentivize the foreign investor not to come to India and rather to invest in his home jurisdiction. And the best way in which you can make him invest in Indian securities is not by asking him to comply with RBI regulations, but by going out there and issuing a DR against your Indian securities. So regulatory constraints you overcome by issuing DRs, home bias you overcome by issuing DRs abroad.
One quick clarification. So we've known of capital controls as a concept in economics. Many lawyers know, many young lawyers and students know of FEMA, but they are not able to appreciate how it ties in with the capital controls. So is it possible to state that the general rule in FEMA for capital account transactions, which states that anything that is not permitted specifically under FEMA is prohibited? Is that the rule we are referring to in general when we are talking of capital controls?
Absolutely, because so there's this huge debate that has been happening in India since the Sahu Committee reports of 1997 about moving onto a fully convertible capital accounts. And this debate has been on for a long time, and I'm a lawyer, I should not be commenting on this debate, but we have slowly certainly moved towards a more liberal regime on capital controls. But again, if you look at a lot of other jurisdictions, all the developed economies, there is no capital controls, right? I mean, there is no restriction on how much foreign exchange you can buy and where you can invest to that extent as in India. So this entire prohibitive approach to transactions is something that we should question, and I guess there are more competent people in this field who are questioning this right now. But as of now, the reality is, and as far as this committee is concerned, the reality is that capital controls exist, and whatever reforms are being made with capital controls in place should comply with capital controls, and keeping in view the practical reality that capital controls and FEMA regulations are in place in India, it makes sense to take advantage of the potential foreign investors sitting out there who are interested in Indian securities but are not investing because of home bias and regulatory constraint. It makes sense if you approach them with DRs.